Welcome back to Money Mindset, where we break down the simplest ways to build your wealth. Today, we're talking about something that's a game changer for your financial future: index funds. If you're serious about growing your wealth but want to avoid all the stress and guesswork of individual stock picking, this is for you. Forget spending hours researching individual companies, trying to time the market, or stressing over every little dip. We're going to unlock the power of simplicity and show you how index funds can be your secret weapon to financial freedom. So, let's dive into 6 simple reasons why index funds could be your best bet for wealth accumulation. First, a quick refresher. What exactly are index funds? An index fund is a type of mutual fund or ETF that tracks a specific market index like the S&P 500. Instead of trying to pick the right stock, you invest in a basket of stocks that mirrors the market. It's diversified, low-cost, and simple. Think of it like buying a slice of the entire pie instead of betting on just one ingredient. You're essentially investing in the overall performance of the market, rather than trying to outsmart it by picking individual winners and losers. Now you might be thinking, but what about those hot stock tips everyone's always talking about? Here's the thing, even the pros struggle to consistently beat the market. In fact, most actively managed funds, those with teams of analysts trying to pick the best stocks, actually underperform the market over the long run. Why? Because they have higher fees to cover their research and trading costs. Those fees eat into your returns year after year. Index funds, on the other hand, are passively managed. They simply track the index, which keeps costs super low. This means more of your money stays invested and working for you, and that, my friends, is how you build real lasting wealth. So, if you're looking for a simple, effective way to invest, index funds are the way to go. Reason number 1 why index funds are awesome. Diversification. When you buy into an index fund, you're automatically investing in hundreds, sometimes thousands of different companies across multiple sectors. This spreads out your risk. Instead of worrying about whether 1 or 2 stocks will go up or down, index funds let you ride the overall market's growth. Imagine putting all your eggs in one basket and then dropping that basket. Not a good situation, right? That's what investing in just a few individual stocks is like. If one of those companies tanks, your portfolio takes a big hit. But with index funds, you've got a whole bunch of baskets, each with a different mix of eggs. Some companies might be struggling, but others will be thriving. This diversification smooths out your returns and reduces your overall risk. Now, not all index funds are created equal when it comes to diversification. You want to look for funds that track broad market indices like the S&P 500 or a total market index. These will give you exposure to a wide variety of companies across different sectors, from tech giants to healthcare providers to consumer goods companies. This broad diversification is key to weathering market storms and coming out ahead in the long run. Remember, diversification is like insurance for your portfolio. It helps protect you from the unexpected and ensures that you're participating in the growth of the overall market. Reason number 2, and this is a big one: lower fees. One of the biggest drags on your wealth accumulation is high management fees. Think of it like a leak in your wealth-building bucket. Every dollar you lose to fees is a dollar that's not working for you. The great thing about index funds is they're passively managed, meaning the fees are significantly lower compared to actively managed funds. We're talking a fraction of the cost, and those savings add up big time over the long run. Let's say you invest $10,000 in an index fund with an expense ratio of 0.10%, and another $10,000 in an actively managed fund with an expense ratio of 1%. Over 30 years, assuming an average annual return of 7%, you'd have about $76,000 more in the index fund, simply because of the lower fees. That's the power of compounding working in your favor. Lower fees mean more of your money stays invested and grows over time. It's like giving your investments a turbo boost. Now, when you're choosing an index fund, always check the expense ratio. This is a measure of how much you'll pay in fees each year. Aim for funds with expense ratios under 0.20%. Trust me, these savings compound big time over the years. Remember, every penny you save on fees is another penny working hard to grow your wealth. Reason number 3, why index funds are a fantastic choice for building wealth-consistent long-term growth. Now, I know what you might be thinking, but the stock market goes up and down all the time. And you're right, it does. There will always be short-term volatility. But here's the thing, historically the stock market has trended upwards over the long term. Despite all the crashes, corrections, and recessions, it's always bounced back and reached new highs. And index funds, especially those tracking the S&P 500, have delivered impressive returns over the long haul. We're talking an average of 8 to 10% per year over the past several decades. That's the power of investing in the American economy and participating in the growth of its most successful companies. Of course, past performance is not indicative of future results, but the historical trend is clear. The key here is to stay invested for the long term. Don't get spooked by temporary dips in the market. In fact, those dips can be great buying opportunities. Remember, time in the market is more important than timing the market. Instead of trying to predict when to buy low and sell high, focus on consistent contributions over time. This dollar-cost averaging strategy helps you ride out the volatility and benefit from the market's long-term upward trajectory. Time-efficient investing. Reason number 4, why index funds are a game changer. They're incredibly time-efficient. Let's face it, we're all busy. We have jobs, families, hobbies, and a million other things demanding our attention. Who has time to spend hours researching individual stocks, analyzing financial statements, and tracking market movements? With index funds, you can literally set it and forget it. You don't have to worry about individual companies. You're investing in the overall market. This hands-off approach frees up your time and mental energy to focus on other important aspects of your life. Imagine being able to build wealth passively, without having to become a financial expert or spend hours glued to your computer screen. That's the beauty of index fund investing. It's like putting your money on autopilot and letting it grow while you focus on what matters most. To make it even easier, set up automatic contributions to your index fund. This way, you're consistently investing, regardless of what the market is doing. You can even set it up to automatically reinvest your dividends, which brings us to our next point. Risk mitigation during market downturns. Reason number 5 why index funds are a smart choice. They help mitigate risk during market downturns. Look, no one can predict market crashes. They're a natural part of the economic cycle. But by being invested across a wide variety of companies and sectors, index funds cushion the blow when individual stocks or sectors underperform. Think of it like this. If one tree in a forest falls, the entire forest doesn't collapse. Similarly, if one company in your index fund struggles, the impact on your overall portfolio is minimized by the performance of the other holdings. This diversification helps you weather market storms and come out stronger on the other side. Remember, market downturns are a normal part of the investing journey. They're not a reason to panic and sell everything. In fact, they often present great buying opportunities. The key is to stay the course and ride out the volatility. Stick with your index fund, continue making regular contributions, and let the power of diversification work its magic. Compound growth supercharges your wealth. And finally, reason number 6, why index funds are your key to wealth accumulation: compound growth. This is where things get really exciting. Compound growth is like the snowball effect of investing. When your money earns returns and then those returns start earning returns, that's compound growth. It's like earning interest on your interest, and it's the closest thing to magic in the world of finance. Index funds, with their consistent performance and reinvested dividends, are perfect for maximizing this effect. Over time, even small amounts of money can grow exponentially thanks to the power of compounding. Let's say you invest $100 per month in an index fund that earns an average annual return of 8%. After 30 years, you'd have over $149,000. That's the power of compound growth in action. To supercharge your compounding, always reinvest your dividends. This means using the dividends your investments pay out to buy more shares of the index fund. This creates a virtuous cycle of growth, where your money is constantly working for you, generating more returns and compounding over time. Remember, the earlier you start investing and the more consistently you contribute, the more time your money has to compound and grow. So there you have it. 6 simple reasons why index funds could be your key to wealth accumulation. They're diversified, low-cost, consistent, time-efficient, risk-mitigating, and they harness the power of compound growth. Start building your wealth today with index funds. Do you already invest in index funds, or are you thinking about starting? Drop your thoughts in the comments below. And don't forget to hit the like button and subscribe for more actionable wealth-building strategies here at Money Mindset. Until next time, keep building that money mindset.